thank you for joining us on our weekly Tuesday webinar. It's April 21st, and there's lots of stuff to talk about today. We've just been looking at the budget that's been announced, and lots of things going on there, so we're going to pop back to that in just a moment. But first, what we're going to do is start with just a little bit of a review from some of the things that we talked about last week. We had a lot to put in front of our audience last week, and what we want to do this week is just go back and highlight a couple of the key differentiators that we think HighRock brings to the table for clients. First and foremost, of course, we talked about this last week, and we really do believe this is something that's really important, and that's our fiduciary responsibility to our clients. And that is part of building the trust that we want to be able to establish with our clients. So having this fiduciary responsibility, which is really our legal obligation to act in your best interest and to not have any conflicts of interest that would come between us serving our clients and putting them first. In order to make sure that we're doing that and to report back to our clients, we've actually hired an independent review committee that will monitor all of the things that we're doing in our portfolios for our clients to make sure that everything that we're doing is within the suitability requirements that we have established through each client's investment policy statement, as well as to make sure that there are no conflicts of interest that are things that would possibly put our interests ahead of our clients. And that's just to make sure that our clients are informed by an independent party to give them that sense of comfort that they're being looked after in that fiduciary way. So that I wanted to point out because we think that's a really important thing. It's completely unique. It's not anything that anybody else does, and it just takes us to another level of commitment to our clients. And that to us obviously is extremely important as we move forward. Another thing that we also discussed, and one of those things was the fees that we're going to be charging our clients. And I wanted to just revisit this because, again, here is the thing that we believe is very important, and that's to make sure that all our fees and the costs that our clients are incurring in dealing with us are transparent. And so I showed this slide last week. Basically, it's a breakdown of what our management fee will be, which includes the custodial costs. So that's an all-in fee, includes custodial costs, trading fees, everything. That's what a client would receive. And then, of course, we want to make sure that everybody understands there are some MERs, management expense ratios, that will be part of the cost to clients. In our research, in the new portfolios that we're going to develop, that cost has been reduced to about 8 basis points. So our all-in cost is just a little under 1.25%. We did some comparative numbers for average investment advisor costs, including fees and embedded MERs, and the average, according to a Vanguard study that was released in the Globe and Mail last November, showed investment advisors, inclusive of MERs, cost to clients at about double what we're going to be charging and what the client cost is going to be. So I think, and Paul agrees, that that is something that is very important. We want to continue to keep that transparency. We know that coming soon, the rules are that we will have to show that. But at this point in time, those rules have not been fully established. So investment advisors don't necessarily have to show that just yet. but we want to make sure we're out in front of that curve, showing our clients exactly what their costs are going to be. Paul, did you want to add anything to that?
Yeah, I was just on a OSC, Ontario Securities Commission webinar for about 2 hours this afternoon, and it was all related to what's called CRM2, Client Relationship Model 2.0. And yes, indeed, you're right, Scott. I mean, all dealers, brokerages, mutual fund distributors will have to divulge many things to their end clients, some of it performance related, and some of it certainly fee disclosure related. And all those fees will be put forth, or they should be put forth, by the brokerage company. So we are, again, going above and beyond that.
So that, in a nutshell, is something that we think is another way that High Rock, as a firm, will hold ourselves above the rest of the pack. Now, a reminder, too, that our management fee is tax deductible. I think that's important, tax deductible for non-registered accounts. Okay, so that's what we wanted to cover a little bit of in just a bit of a review of what we talked about last week, but just to bring those two key points home again. Okay, so now we want to move on a little bit and talk about a little bit about what's been going on in the markets. And I've had a theme in my blogs over the last few weeks about what we think is a fairly expensive, or what are fairly expensive financial markets. And basically the rationale behind that is that we've seen really low interest rates driving both equity and bond prices, market prices, to record levels. And we want to talk a little bit about why we think that this could potentially develop into what we think is a bit of a bubbly situation. And Paul, do you want to talk a little bit about this before I move forward?
Only to say in very mathematical and technical terms that the chart you're showing on your desktop right now in the webinar, people can obviously go back and see the peaks and then the ensuing troughs. And I do believe mathematically that that is a 2.5 point standard deviation from the mean, which means that you can see back in 08, well, sorry, 0008, and where we are today. Those are all 2.5 point or more standard deviations from the mean. And I think one probably, certainly I believe in reversion to the mean. So we are a little bit overshot here, and one can see that by simply looking at the graph. But mathematically, that is true.
And I should have pointed out that this is the S&P 500 from 1995 through till today, so on a monthly basis. So, and we can break that down and look at it on a daily basis, but we can also see technically where we are right now. And one of the things that I pointed out in my blog the other day was that the market is having some difficulty getting back to the highs that were made in the end of February. And a market that can't make new highs is destined to test the lower support points. And right now, the lower support point is this lower trend line. It's an uptrending trend line. So interestingly enough, this band is narrowing. And at some point in time, that market is going to break one way or the other. On a longer term basis, we expect that there will be greater downside pressure as investors realize that they have asset prices right now that are very steep. However, the way the central banks have been stimulating the global economy with their aggressive monetary policy continues to push interest rates lower, and I talked about this in the blog today, but lower interest rates are forcing investors out of bond markets and into more risky asset classes. Now, that situation may change in the not too distant future as we start to see economies pick up and as we start to see inflation picking up. But right now, bond markets are telling us that inflation isn't expected to pick up significantly over the next little while, and that could be enough of a catalyst to continue to drive prices higher. So in the short term, we've got this narrowing channel, and at some point in time, prices are going to break out either to the upside or to the downside. That's how these technical markets work. We think on a longer term perspective, the likely, as Paul said, is the reversion to the mean, and that mean is considerably lower. So, however, we continue to always monitor these situations as they evolve. We always look for opportunities if they present themselves by virtue of these technical situations. Paul, did you want to touch on the demographic issues as well while we're talking about assets?
Sure. Did you put up that one chart? I sent you a chart that actually explains the demographic situation in the preference. It really, Scott's looking for it. Really, what this chart shows is the investor preference for stocks versus bonds. As investors age, they can take less equity volatility, and we certainly have seen a lot of equity volatility, in periods back in obviously 00 and 0203, and then again obviously in 0809, and we've seen smaller amounts, but we've still seen some equity volatility. August 2011 as an example. That was the chart. So this chart here is a little complicated. But what it shows, it's a Federal Reserve Bank of San Francisco study I found in August 2011, literally the day after it was published. The chart on the left shows the MO ratio, which is these are U.S. statistics, the middle age cohort divided by the old age cohort, and the red line is the PE ratio of the S&P. You can see how they have a very tight or very high correlation. The chart on the left is the S&P PE ratio in blue, the actual ratio, or where it should be, and the model generated as to where it should be. Now today we're trading at a PE ratio of roughly 18 times. That is 17.2, but I think we're almost closer to 18. And we appear to be very overvalued to where the demographic is. And I think what Scott was referring to earlier, why is that so? Why is the market trading so expensively versus the demographic, which is obviously aging for the next 30 years, as we know it, the 65-plus cohort expands very dramatically in most Western economies. And I think the reason why is quite simply people need return. And they kind of look at the bond market and think, oh, it's 1.5%, I can't get enough return, and they extend risk into obviously the bottom of the capital structure, into equities, and that's the riskiest part of the capital structure there is. So I see that as another example of the equity markets being rather overvalued at this stage, most certainly against the demographic.
And another reason why we continue to be somewhat cautious about current prices. So, and by saying we're cautious is that when we get new cash, we're somewhat reluctant to put it to work, certainly in equity markets at this particular point in time. A couple of situations, though, that we think do make a little bit of sense, certainly at this point, is the high-yield market, especially the Canadian high-yield market. Paul is certainly one of the top Canadian high yield portfolio managers, and I'm just going to let him talk briefly about why we think there's some value there still.
Thanks, Scott. Kind words indeed. The Canadian high yield market, actually I'm going to pull up a chart, you won't be able to see it, just for edification. The Canadian high yield market traditionally trades very cheaply to the U.S. market. And in fact, we're about 1% or so higher yield than the U.S. market. That's the first thing. I mean, we could probably go back and do an entire call on what are high yield bonds, but generally speaking, high yield bonds are, they sound scary. People refer to them as junk bonds, but they're really very high up in the capital structure of a corporation. So a capital structure starts with bank debt at the very top, then senior unsecured debt, then convertible bonds, then preferred shares, and then stock at the very bottom. And high yield bonds are quite often senior secured and sometimes on par with the bank debt. So that's the first thing people need to know about high yield bonds is they are often secured. In two of the portfolios that High Rock manages on behalf of Scotiabank, we've got just over 40% of the portfolio is in senior secured bonds. So very structurally senior in the capital structure. And then the second thing people need to know is that high yield bonds actually are backed by an indenture, which is a legal obligation of that issuer to perform in a certain way. And there are certain things that they can do and certain things they can't do. So they are limited by the indenture. And those, they're called covenants. And the covenants are there to protect us as bondholders. And right now, and especially in Canada, we've seen over the past 4 or 5 months, the market has weakened off with the price of oil and other various commodities. There seems to be a fair bit of value in the high yield market still. And we have improved over the last few weeks as some of these commodities have found a bit of a temporary base. But don't forget, each day you own a bond, you collect accrued coupon interest. So that's important to know versus a dividend stock. If you're driving yield in your portfolio strictly through dividend income, dividend yield, you only get that dividend when you hold the stock on a certain day before it goes ex-dividend. So there's a difference between high yield being true yield and dividend yield being manufactured yield, because really it's simply, a dividend yield is simply a promise to pay. They can cut the dividend, they can cut it to zero, they can cut it in half, they can do whatever they want. There are no repercussions to that issuer. So that, Scott, I hope that answered some of your question, but that's probably a longer discussion to really get into high yield.
Absolutely, and it's helpful just to understand that high yield has more depth than some might think it does, and that depth and looking at the covenants that different bond issues have, I think that's where we get a fair bit of comfort in the world of high yield.
Yeah, and it's that's a good point, Scott. Not easy to do. When I look through an indenture, there are 250-page documents. They're written by lawyers, so it's full of legalese. It takes me about anywhere from a day to a week to go through an indenture and to do credit work and create an Excel file and create a model on any single issuer. So they are very complex instruments and securities to work through, arguably much more so than doing equity analysis, because you have to layer in the indenture. So they are complex, but they are structurally senior to equity.
And that brings us to our next discussion topic, and something we've been really touching on as we reevaluate our model portfolio, looking for securities that do generate return and maybe cash flow. Some of our recent research in preferred shares has shown us that the newer issuance has tended to be to gravitate towards these rate reset preferred shares. And as a number of rate reset preferred shares have come to maturity or have been rolled over at considerably lower interest rates from the time that they were issued 5 or so years ago, we've seen that the preferred share index has in fact declined quite significantly, almost by 10% through just the last 4 or 5 months. So we've been doing some further research on preferred shares. And Paul, why don't you just, if you can, in a nutshell, tell us about some of the new rules for the banks that have come forward?
Yeah, I would just comment first of all, Scott, just some preferreds in general, especially the fixed resets. People for the past 6 years now have been saying that interest rates are going to go up, and quite frankly, they've done nothing but go down, and that is now globally. I think, as you mentioned earlier, that's largely due to deflation. Inflation is the enemy of bonds. Deflation is the friend of the bond market. When we say the bond market, we're talking about government bonds. So a lot of people they wanted floating rate debt or these fixed resets, which would fall into that bucket, because they didn't want to get hurt if rates rose, and everybody thought rates were going to rise. Well, they didn't. So that's part of the reason why the fixed reset and the pref market in general in Canada has been hurt, because now the refi risk for the investor, the risk is higher because your reset is going to be a lot lower. On to Canadian banks, who obviously have a lot of preferreds outstanding. The preferred market has been mostly a retail-driven market, so the investment dealers and banks in Canada offer a lot of prefs, and especially the banks, through their dealer networks, and that's how they funded themselves. Well, something new came as of January 2013. It sounds old, but really just started about a year ago. So there's something called, it's a very complicated matter, and I'm just starting to do research into it, and I've got a friend who happens to be an expert in the country in this. So I'm getting a lot of information to get me up the curve fairly quickly. But effectively, Minister of Finance and the Office of Superintendent of Financial Institutions, which regulates banks, have declared that all the capital that the banks raise now has to be considered equity capital, again, at the bottom of the capital structure. And that is called non-viability contingent capital. So when you buy a deposit note, bank, any of the Canadian banks, deposit note, a senior debt, subordinate debt, preferred shares, they can all, on a trigger event by OSFI, that being if that bank is considered by OSFI to be non-viable, they can all trigger down and convert automatically and not reversible, it's permanent, they all convert to common equity. So for instance, and one of the reasons I think we're doing a fair bit of work on this is some of the preferreds in the market are grandfathered, some of the bank preferreds, and the new ones obviously are NVCC, non-viability contingent capital. So they're trading flat, like the same price, the same yield. So I think we'd rather buy the old grandfathered ones that cannot be converted to capital, because the new ones are going to, in a terrible situation, get converted to common stock on a ratio basis. So there is much more protection in some of the older grandfathered security of the senior debt, subordinate debt, preferred shares, and of course, common is common. So there's a lot of work to be done. I wouldn't think very many people know a lot about this. It is a very complex thing, and quite frankly, I think the target is still moving from OSFI. But we are doing our best to protect ourselves and our clients so we don't get tagged by some changing regulation, because it is changing.
Thanks, Paul. I know that's a complex issue, and If there are any questions that anybody would like us to follow up on with this to explain it in more detail and how it may impact a portfolio at some point in time in the future, we're happy to do that, of course. Again, this is research that we're doing as we make our selection of securities for our new models, and this is something that we want to make sure that we're discussing with our clients. Also to let them know that we're digging down and looking at all of the risks that are associated with owning any investment, not just price risk, but what if scenarios should develop where we get situations where, as Paul said, there is some really ugly situation that happens to a particular financial institution. We want to make sure that our clients are as protected as possible. Okay, we've just had the budget come out. We have a couple of minutes. I'm just going to flip over to on my screen here to the Globe and Mail has put out a number of key points. I think the ones that are the most pertinent to our clients certainly are going to be the increasing of the limit for TFSA contributions. So raising it to 10,000, that's almost doubling it, but 10,000 per year. I think that's a really, really important long-term situation. If at this juncture a client can have up to 36,500 in their TFSA if they were 18 or older as of 2009. So that going forward and continuing to see these the TFSA limit extended is really in the next 10 to 15 years going to mean that you're going to have the ability to have contributed, 15 years, we'll say another $150,000 on top of that. So we're talking $200,000 of money that is growing tax-free. I think that's going to be absolutely incredible for retirement planning for all of our clients. Another thing that came out today was somewhat expected, but not exactly the details. But when it comes to registered retirement income funds, and for most of our clients, they know that when you reach the age of 71, you have to convert your RSP into an RRIF. And up until today, the minimal withdrawal once you start to take money from that RIF at age 72 is 7.38%. Well, that's been reduced to 5.28%. So just to put that into dollars, basically what that says is that if you have $1 million RSP and you turn 72, instead of being forced to take taxable income of $73,800, you only have to take taxable income of $52,800. It lowers the impact of taxation on your withdrawal, and I think that's going to have lots of potential for us to review our wealth forecasts for all of our clients as we go forward. So those are all the things that we wanted to discuss this week. I'll open the floor to any questions. If anybody has any questions right now, please feel free to throw them our way. All right. Well, it sounds like we've probably given you way too much information once again this week, and everybody's got to digest it. So, as I said, we're always available. If you have a call, if you have a question, we're available to have a call. Send us an email. We're always here, standing by, looking after your portfolios for you, and want to make sure that you're in the loop as much as we can. But I'd like, on behalf of Paul and Bianca, I'd like to say thank you again for joining us. And we will be back next week with another webinar. And if anybody would like to receive this webinar as a recorded version, please just let us know. All right. Well, everybody have a great week, and we look forward to next week. Take care.